This is Pastor Alex Lappos, representing the Pastors' Council of Bethel Pentecostal Church with Dimitri Lappos, and we're going to speak about potential investment of our money from the sale of our building to the amount of $800,000. So here we go.
Hello, Dimitri Lappos here, investment advisor with Manulife Securities Incorporated out of Dorval, Quebec. Yes, so my understanding is that you sold your building, you have proceeds of the sale, and you're looking to buy a new building.
Eventually.
What's the timeline?
Okay, well, there's no timeline, but
Okay.
I think it's, right now, let me tell you our situation.
Yeah.
We sold the building for $1.3 million.
Okay.
And after everybody got their cuts,
Yeah.
we were left with $900,000. But 70,000 of that, actually it's more than that, 930,000.
Okay.
70,000 of that is a balance of sale.
Okay.
So the buyers are paying us $3,200 a month approximately for the balance of sale at 3.8%.
Okay.
That's another church, so
That's
we didn't
good.
want to give them a high interest rate.
Yeah, but 3.8 is still
But
competitive.
the situation that we're in now is that we're renting the same building,
Yeah.
our church building, in the afternoons at 2:30. This puts us in a fantastic situation because we are now making money every month.
Yeah.
We have extra money that is coming in, but we don't necessarily have to use it.
Yeah.
So even if we put aside $800,000 into an investment, every month we could put in this $3,200 on top of it.
Yeah.
Just keep investing. And what I was trying to convince our council of is that the last couple of years we've been in a bit of a decline, and every month we've been losing money. That's not the reason why we sold the building.
Decline in show-ups or decline in money?
Just money mainly.
Okay.
The show-ups were good. So anyway, so we were declining, but we're in a position now where every month we can increase. So I thought that at least we should take advantage of that for a little while, and then look for a building sometime when the snow melts.
Okay.
So I figure that sometime in this year we'll have to take out whatever money we invest and
Yeah.
put it. I don't think I'd put the whole amount as a down payment.
Yeah.
So I was going to ask you about two things. One, a safe investment that can be cashable at any time,
Yeah.
or a low risk investment, like an investment with a bit of a higher risk, because I'm not afraid to risk.
Yeah.
That,
But it's not only you investing, right? It's
No, it's the whole
board,
church.
too.
Yeah, I know. But I thought I could ask about it anyways.
I have no problem coming and presenting to the board as well, talking about if that's the route that you feel for a portion of the money maybe
Yeah.
should be taken with a little bit more risk. I don't want to say high risk because it's not. I don't do high risk. That's
Yeah.
not what I do. What I
Okay.
do is build people's retirement wealth,
Yeah.
whether it's through a company,
Yeah.
whether it's through an RRSP,
Yeah.
whether it's through whatever.
Yeah.
It doesn't matter the vehicle. I have licenses to sell anything from any company.
Yeah.
GIC, PPNs, mutual funds, stocks, bonds,
everything.
whatever.
Okay, good.
So you're not here just seeing Manulife. Manulife is just the back office that's my. They make sure that everything I do is, for lack of a better word, kosher.
Yeah.
They check my books, they
Yeah.
audit me, so
Yeah.
that's how I have a tie with Manulife.
Okay.
None of my clients actually deal with Manulife. You just get the statements.
I
That's the
understand.
only thing that says Manulife.
Okay.
So basically, there's a couple ways that we can go about it. One, fully redeemable GIC, guaranteed investment certificate, where you would be earning a little bit of interest, nothing exceptional.
Yeah.
I wouldn't say locking it in at all, so it has to be fully redeemable.
Yeah.
Lock-in GICs are paying you approximately 3% right now,
Yeah.
where redeemables are a little bit more than half. You can get about 1.6, 1.7 if we shop around, but also I don't want to risk, because it wouldn't be through Manulife if we went higher than 1.6%.
Okay.
Manulife is a very solid name, so if we bought a GIC through Manulife, there's no like risk of insolvency. Where if we buy like Home Trust, there is a risk of insolvency. That's why they must pay a higher rate of interest, right? So basically, there's the two ways. One, get a redeemable GIC.
Okay, that's
Two,
one.
Two is get a redeemable GIC for a large portion of it and put another portion in the markets. That's a way that you may seem interested in.
Yeah.
The third option being invest the whole thing in the markets. I would not do that.
I wouldn't do that. No.
We're coming off a very rough December. January and February have been very, very fruitful. and I think that this is going to continue until at least the end of Q1.
Okay.
So, there was a slight bump in people's assets for my clients. I'm not going to hide behind it. I think my worst client did -3 last year, where now they have gained the capital that anything was lost. Everything has been gained, and a lot. So people are like up 6%. So that includes the loss of 3 last year. So there have been very, very high upswings. And I think that this will continue, but not for the long term. So my advice to you and to your board would be maybe going about it just the GIC way, just the redeemable GIC. Why? There's too many questions right now. We're dealing with money that your church needs.
Yep.
There's no reason to be putting it, unless it's a long term. If there's a time horizon for a certain amount of money, if you're saying that, okay, half of it's going to be put down on a building and the rest is going to be slowly taken out and paid for towards a mortgage, let's say, on the building, okay, then a portion can be invested. But if you want the majority of that money to go towards the purchase of the next church, I would not recommend putting it into the markets at all.
Okay.
Just because that's not a good move. What I'm best at is making sure that your portfolio pays itself. So dividend yields being high in your portfolio. That means that the investments that you have inside the portfolio pay you just for holding them, regardless of the growth or shrink.
No, I understand.
So I'll give you an example.
Okay.
RBC stock.
Yeah.
Right now it's valued at, let me just double check here. Didn't check while I was at lunch. RBC stock is at 102.37.
Okay.
Right now, 102.27, excuse me, right now. So to buy one share of RBC costs you $102.27.
Right.
That pays you 98 cents per quarter.
Okay.
Per share.
Right.
So every share you hold, you get 98 cents 4 times a year.
Okay.
That's $3 and
Yeah.
92 cents. Approximately 4% of your investment is guaranteed to come into your hands.
Oh, okay, yeah.
RBC only increases its dividend yield. They increased it the last time in November 2018 from 94 cents to 98 cents. And like the historical, I'll go back to 2000, they were paying 13.5 cents. And they've only increased it. Even in 2008, when the stock plummeted by 30%, 40% close to, they still paid a dividend at 50 cents per share per quarter. And they continued that for 2 years till 2011. Then they increased it to 54 and 58, and it continued going up until it came up to 98 cents. So that's a very good investment.
Yeah.
But it's good to hold long term.
Yeah, long term. Yeah.
RBC is doing a rally upwards now. When is it going to correct? Because I think that it's a little bit overpriced right now. So I don't necessarily want to buy into it with money that you're going to be using on the short term. So that's why I wouldn't necessarily recommend putting any money into the markets if you're going to be needing it on the short term. And by short term, I'm talking about like 2 years.
Okay, 2 years. Yeah.
Within 2 years.
Okay.
Anything less than 2 years, don't put it into the markets.
Well, we still have to decide how much we're going to put down as a deposit if we do find a new place.
So that's, yeah.
We have 2 years where we're receiving $3,200 a month from the buyer. That's 2 years. That's plenty of time to grow the church and to increase the income and be able to afford any kind of mortgage that we would take out.
Yeah.
But these are decisions we haven't even looked at yet. I just wanted to speak to you first.
Yeah. So, I mean, really, the only advice that I can kind of plainly give based on the information that I have is buying a redeemable GIC would be your best bet. Okay. Only because you're guaranteeing a growth. It's not incredible, but on $800,000, we're talking about $80,000. No, not 80. $8,000. Excuse me. $8,000. Yeah. 8 and plus 1 point. Let me just get the actual number.
Yeah. Okay.
So on 800,000, I'm horrible with mental math.
Yeah. Okay.
Schooling was 1.016. Your 800,000 would grow by 12,000. Excuse me.
Oh, okay.
And this is like
just
guaranteed.
by doing nothing.
Just by doing nothing. This is just interest.
Wow.
Now, interest. Here's the problem with interest is that it's fully taxable.
Yeah.
Oh wait, no, you don't.
No, we're a church.
Oh yeah, forget it. So even on interest on investments, you're not taxed.
No.
Ha! man, I got to
Great.
start a church.
Just join ours.
Yeah. You
I'll
have
make
to
you an
see
assistant.
the kind of tax problems that I deal with clients. But that's the best problem that you can have, just paying tax, right?
That's it. Well, I don't
Means you're making
even
money.
personally. I don't pay.
Yeah,
a lot
exactly.
Of tax.
Yeah. So yeah, basically you can bring it up by 12,800. That's 1 year of investment in a very simple high interest savings account offered by
Yeah.
Manulife, fully covered
Yep.
in case of insolvency.
Well, the one thing that we know for sure is that we need a facility that is on the ground,
Yeah.
no floors. We need a facility that has handicap access, facilities for kids and
Yeah.
parking.
Okay.
And we refuse to look at anything that doesn't have those stipulations. We must have those things. We're not going to buy anything unless it has those things.
Okay.
So right now we're renting. We're in a beautiful situation because we're renting the same building that we were in,
Yeah.
and we're paying $300 a week.
Yeah.
Well, that's a lot less. I mean, our expenses are almost zero because we don't own it anymore. We're not paying gas, electricity, insurance. I mean, it's incredible.
Uh-huh.
And I don't know exactly how much we're making every month, but it's got to be at least $4,000 to $5,000 a month, on top of the offerings and everything else that comes in.
Okay.
That's a lot, man. And I don't want to just sit in the bank.
Yeah.
I want to do something with it.
Yeah.
So these are all the things that we need to discuss. You probably will have to come in and make a presentation, I think.
Look, if you're talking about steady income and income that you want to generate more income from investment, the only thing I want to make sure, and the only reason why I'm giving you the advice that, don't invest this lump sum of $800,000 is because you're going to be using it soon.
Yeah, that's right. Well, eventually.
Eventually, yeah, but less than
Probably
2
not
years.
all of it though.
Not all of it. So
Probably
that's where
probably 6.
That's where you guys need to figure out a number, because we can grow and we can grow your money and have it grow efficiently, and you can still have it available to you. Like, there's good liquidity where you can sell and within 3 business days it's back in the corporate account.
Yeah.
And it's done. We can also help with, I was going to talk about taxes here. I was going to give you the tax pitch, but it doesn't matter. So even better. Even better.
Well, last time we bought a building, we had $600,000 in the bank because they had sold their building way back. So they made about 600. We put $100,000 into our general fund just for expenses. That carried us for 12 years. Mm-hmm. It's a long time.
Yeah.
And we put $400 down and we mortgaged $300.
Yeah.
But this time we have more money to deal with, so we'd probably put down $6 and mortgage the rest.
Okay.
And that would leave us with $2.
Yeah.
To do something. That's pretty good.
If that's what you guys feel, then I would be comfortable I would be happy putting $200,000 into the markets.
Yeah.
And I would talk about investment strategy. And there's a time to be conservative. There's a time to be aggressive. It's not just going to be, okay, let's sit you in a balanced fund and I'm not going to talk to you. Nah, there's going to be moves. There's going to be moves that are going to be made. And if it requires me to come and talk to the board before an investment move is made, I have no problem doing that. I'll come by and I'll tell you guys why.
Probably be out here somewhere, or we probably meet here.
It could be a lunch meeting. It could be here. I got a boardroom. I'll come in and propose the move.
Yeah.
Like, for example, I'll give you an example.
Okay.
I made 2 moves last year.
Okay.
I don't need much with the types of portfolios. I like income portfolios. So portfolios that generate interest from bond coupons, which is basically like a bond dividend. You know what a bond is, right?
Yep.
A little bit?
Yeah.
For those that will listen to this and don't know, I'll explain quickly.
Go ahead,
A bond being a debt, like a debt instrument. If the government of Canada wants to fix the Champlain Bridge again, they need to borrow
from us
$1 billion, right?
Okay.
And they can't just go to the case pub. It's not like Trudeau just walks over and says, "I need $1 billion." So they issue bonds. They say, Pastor Alex, Dimitri Lappos, whoever else wants to buy these bonds, give me $100 today, and I will give you $101 next year.
Yeah, I understand.
So the interest is being 1%. They actually pay it in coupons, so it depends on the type of bond. It gets more complex, but basically they'll pay you a quarter, like 25 cents.
Yeah.
Every 4 months, and then they'll give you the $100 and that 25 cents to cap off that $101 debt that they owe you. So that's how a bond works. But bonds are traded, and there's a market for them. When equity markets plummet, bonds are actually a thing to save a portfolio. So what we did in our portfolios was we held a slew of bonds and stocks. Basically, the interest rates in Canada were rising last year. For the last couple of years, they've been rising, right? And interest rates inversely affect bond prices. So when interest rates go up, bond prices go down. So that $101 bond won't trade for $101 anymore. It'll trade for less.
Okay, I understand.
Yeah. So what we wanted to do was we wanted to get out of Canadian bonds at the beginning of the year because we knew that the government was raising interest rates. So we sold off our Canadian bonds, a portion of our Canadian bonds. We still wanted to keep some because it's very good security against downward markets, and we didn't know what was going to happen last year. And for the first quarter, it was kind of crap. Second and third quarter, there was a lot of growth. There was a lot of recovery from what happened in the first quarter of 2018. I don't want to go too fast. Stop me if I'm going too fast.
No, you're okay.
But basically, what we wanted to do was we wanted to hedge our security blanket, which are our bonds. So we sold off the Canadian bonds, about 25% of them, and we bought into global bonds. So bonds that are issued out of New Zealand, they're paying like 4%. Still a stable economy, you know. When I'm buying like Venezuela, where their economy is crumbling and their people are protesting, and we're not doing that kind of stuff, but we're buying into Norway. Their latest issue was 4%. Singapore, an emerging market. These are all very, very stable economies that are not as powerful as North America, so they pay better. They pay better yields on their bonds. However, you're taking a currency risk there as well, so we have to hedge that as well. We have to be very smart about how we do it. So we bought into that. We bought out of Canadian bonds and bought into global bonds, and that saved us about a percentage last year. 1% on my average portfolio was saved by that move.
Okay.
That's not incredible, but that's a percent that we don't have to go and get 2%, to catch up to that. We don't have to do that anymore. Then the second move was actually to get out of the equity markets, about 10 to 20%, depending on the client. Move money out of the markets into the bond market because that would protect us on a downside swing. And that happened in about August, and we turned out to be exactly on the money with that move. So that's why my worst portfolio did about -3. Where my best one didn't lose anything at all and maybe gained a percentage or two. But then in mid-January, when we started seeing people put money into their RRSPs, that creates a kind of false stability in the markets and created a rally, which we're still seeing today. Basically, we're up, like I said, somewhere 9% on my average portfolio just because we moved about 10 to 15% from our bonds into our stocks, back into the stock market. When RBC, now it's trading at 102, it was trading at 93. This is there's a very big difference.
Yeah, it's the river.
So that's really what the idea is. Not only that, but buying RBC at the time that we did, buying back into it, we always had a portion, right? Because we always want that dividend yield. But buying back into them, we're going to be collecting the dividend that's going to be coming out in early March. So in a few weeks, we're going to get paid another 98 cents per share, and we hold like hundreds of shares.
Yeah.
So it depends on the size of the portfolio. The larger the portfolio, the more you're going to get paid from dividends.
Well, yeah, obviously.
And your dividend yield is higher, like way higher, than whatever a GIC can get you. In fact, it's safe to say that, well, not really safe to say, but I could say with some confidence that the portfolio yield that you'll be receiving, the dividend payment that you'll be receiving from the $200,000 if you invested that in the markets is going to be higher than what you would be paid in interest from a redeemable GIC in the $600,000.
In the 6, yeah, of course. Yeah.
Of the total 8. So I would like to see your money work as hard as it can for you, but my suggestion is whatever will be used towards the down payment of the next church purchase should be completely avoided of risk.
Yeah, okay.
Whatever else you guys will agree upon, that could work out heck of a lot harder for you.
We're gonna have a long discussion about this because
Yeah.
we've got 3 bankers on the council. So
Excellent.
oh, well, RBC.
Oh, yeah,
RBC
perfect.
people.
Yeah. So, I use a lot of RBC too. I'm a big fan of RBC Bond for what it is.
Yeah.
Plain vanilla Canadian bond fund.
Yeah.
It did like 1.5% last year.
Yeah.
It's not incredible, but the markets were offering in Canada was like minus 11.95 on the TSX last year.
Yeah.
And the S&P 500 did like almost minus 7 in US dollars. And RBC Bond being a bond fund, that's the safety net, and obviously your 200,000 that would be invested, a significant portion of it would be in fixed income, in bonds, and that may include RBC Bond Fund. It all depends on, because these things are timely. It depends on what's up right now.
Yeah, I understand.
Flexibility in the portfolio, which if people are bankers at RBC, I know that Manulife securities brokers and whatnot have a negative stigma with, they're going to lock you into funds and whatever. I don't do that type of investment, especially with somebody that needs liquidity.
Yeah.
We would go into a fee-based plan where it would be like me charging. I must charge. I can't not charge.
I understand.
A client because Manulife has to make their commission as well.
Yeah, of course.
So we would be going into a fee-based approach where. And this is apart from the GIC. I'm not talking about GICs. I'm talking about whatever's invested in the actual markets.
Okay.
I would charge. It depends on the size. So at 200,000, it would be like 1%. I would charge whatever the minimum is, and I would disclose whatever the minimum is so that you guys can see.
Yeah.
And I would obviously go and present this to the board.
Yeah.
I'm not greedy. I get paid very, very well, even with the minimums.
Yeah.
So we can do that, as well as whatever the mutual funds would cost us, but also hold individual positions inside that and not charge you for any trades. So if we know that we're going to be holding, like I told you that we got out of the equity markets, that includes selling a little bit of RBC last year when it was valued at like $100 a share, which right now we're up, but it's temporary. But I'm always forever, ever going to hold RBC in every single one of my portfolios. Forever, a portion, at least a portion.
Yeah.
So if I'm going to do that, why would I do it through a mutual fund and charge you? We'll hold the actual stock, and you'll collect the dividend immediately. You won't have to pay for.
No, I understand.
There's no NERs, on top of that. So we would hold the positions that way. And it wouldn't only be RBC. It would be a number of the Canadian banks. It would be CN. CP Railway, Johnson & Johnson.
Yeah.
I mean, excluding Johnson & Johnson, when we're looking at investing in Canada, it's like a huge scam. You want a bank? Where are you going to go? One of 5 major Canadian. Okay, yeah, you can throw National Bank in there, Laurentian if you really want. They're closing a ridiculous amount of banks or branches. You can say Desjardins in Quebec, but no, not really. There's 5. We got RBC, we have TD, we have CIBC, we have BMO, and we have Scotia. These are the 5 banks that are coast to coast, and they're starting to go elsewhere in the world. TD's huge in the U.S.
Yeah.
CIBC's starting to make a presence in the south, even below Mexico, in the Caribbean, and in that area.
Yeah, Central
where it's
America.
hot and nice. Yeah, but northern and Central America. Where else? Anyway, all these banks are all making
spreading out.
They're all spreading out. Yeah, and I mean seriously, I went to New York City, and everywhere there was a Chase Bank, across the street was a TD, Toronto Dominion Bank across from. Like it's crazy.
Amazing.
Yeah, and these are very, very profitable companies. They're super profitable, and I think that this is something that you should hold, yourself instead of inside a mutual fund. But apart from that, so where do you want to bank? There's 5. Where do you want to ship freight across Canada? Now, right now, that's how we do business. Is it CP or is it CN? You want to use a cell phone carrier? Which one? There's a few to choose. Very high entries, barriers to entry. And very profitable companies that have a very long history, and they pay dividends and only increase their dividends. They've never decreased any of their dividends, these companies that I'm talking about. And there's a lot in the U.S. as well. There's Johnson & Johnson. There's Costco being an amazing company too. Yeah. Costco is kind of on the fence in my books.
Yeah.
I'll give you an example. I returned a couch that I bought 6 months ago.
Yeah.
And that's all cool. That's all good. It's all they came. I just had to pay for them to come and pick it up. It was like $100. But 6 months after I returned the couch, and they just gave it right back to their supplier, saying like, "Deal with this, give us our money back." You know?
Okay.
So that's how they operate, and I think it's a little bit cutthroat, and people might not react well once the market finds out about that kind of crap. But anyway, that's just one stock. It still pays dividends and grows its dividends, and until something happens, like I think it's a buy. But anyway, that's on the 200,000 portion, and I can talk about that for days, and I would like to reserve a spot to speak to the board if they are open to having a portion of that 800,000.
Well, we're going to find out
on the side.
I think it's a good idea, personally.
Yeah, I mean,
really do.
if you're only going to put 6, if everybody is saying, yeah, we're going to put 600 down, then 200 can be working for you a lot harder on a longer term.
You have no idea what becomes available when you're a church. Anything can come up anywhere.
Yeah.
And nothing can come up anywhere.
Mm-hmm.
So that's the dilemma that we face. And there's a moratorium in Montreal. They will not license or zone new churches in like an industrial building. If you wanted to buy one, if you wanted to rent one, it's a no-go.
Okay.
But they make exceptions too.
Okay.
Because they made an exception for us when we were looking for a building in Saint Laurent. They were going to give us the Saint Hubert barbecue building. That was there. Yeah.
Cool.
So then they made an exception. They make a lot of exceptions, and depending on the borough, like a Huntsic, Verdun, LaSalle, the exception rate is higher or lower depending on where you want to go.
Mm-hmm.
So
cool.
So we're going to talk it over, and then I'll get back to you.
Yeah, for sure. I mean, I'm in no rush.
I don't know how long they're going to take.
Yeah, I know.
It's a
how
lot
it
of
works.
money, and we want to do the right thing.
Of course. And I would suggest shop around as well. Go speak to other institutions and see what they have to offer.
They'll probably tell me what the bank offers.
Yeah, for sure. Just the only thing I would say avoid at all costs is locking in that money.
Yeah, we're not
any GIC that's not redeemable, like you're shooting yourself in the foot.
Yes, that just one point that's very important.
Yeah.
If we invested the 200 in the markets, would it be locked in?
No.
That's important.
No, completely liquid. I mentioned that
extremely important.
Yeah, no lock in.
No
lock in at all.
We don't want to lock in anything.
Exactly. Not $1 will be locked in. In the fee-based model, it's completely liquid. You want to sell and take everything out. It's 3 days.
Yeah.
And it's back in the account. 3 business days.
Yeah. Okay. What about
for
the GIC?
the trade to settle? The GIC, it's the same. It's the same
3
story.
days?
I need to fax. Honestly, I don't do big GICs for above $100,000.
Yeah.
It's a different arm, and I haven't purchased a GIC for
let me know.
over 100,000. But I'll get back.
How long it would take to redeem it?
Yeah. So I'll get back to you with that answer. I don't like giving half-ass answers.
No, I know. Of course not.
How long GIC?
Yeah, that's all. You've already told me what the market investment would be, 3 days, and I just need to know that one.
That's what I do, right? That's where that's my expertise.
Okay. So that's it.
Yeah.
All right, let me just turn this off. Okay. Wait a minute, one more.
Is it stopped?
Yeah, it's still on.
The last thing I do want to mention is that we're a member of the CIPF. CIPF being the Canadian Investor Protection Fund. So all of your accounts, and I would suggest that if you go to a bank or whatnot, ask them who they are insured by.
Yeah.
The CIPF covers in case of insolvency up to $1 million.
Oh, that's great.
Where the other where typically bank branches are I forget the name. I don't use them.
No, they'll know.
It's up to $100,000, so that won't cover you. Now, that's if the bank goes insolvent, which is very unlikely, and the same thing with Manulife. But if you want an insurance policy